Welcome back to Switzer. Investors have faced multiple headwinds in 2015 which have impacted portfolios. Extreme volatility and challenging market conditions have meant that a number of quality stock pickers are thriving and outperforming key benchmarks as the year comes to a close. Our next guest is regarded as a quality stock picker and he's here to share his views on the world and how he's investing. Charlie Aitken, welcome to Switzer.
Marty, good to see you.
So, pretty tough year for stocks, number of headwinds, the Fed, China, Europe, leadership, a whole range of different things.
It's a very long list, Marty.
We could be here for hours. What's your position on what's happening in global financial markets right now?
Well, I think global markets have had their correction. I think we'll get through the Fed in the next few weeks. I think the equity valuations are relatively cheap versus bonds, and I think the world will move forward, but you've got to pick stocks, and you've got to pick stocks that can grow. I don't think it's as easy as owning indices. I don't think it's as simple as that anymore. You can see today, even in the Australian market, a huge divergence of share price performance, between different sectors and stocks. I think it's about picking stocks from this point on. But I don't think, we're at the end of the bull market. I think Australia's probably quite cheap, actually. And I think if the world thinks the Australian dollar's bottomed, Australian equities will do a little bit better as well. So I'm quite constructive at the moment. We're about 80% invested and just working our way through it, trying to find things that can grow from here.
And what sort of rough percentage have you got to Australian compared to international?
About half-half at the moment. We're tilting that a little bit. We've brought all the hedging back to Australia, so we've brought back all the currency shorts. We think the Aussie dollar can go a little bit higher after the Fed. Okay. We also think the Australian economy is going a little bit better on the East Coast.
Some good data last week.
Yeah, look, retail sales, unemployment number, GDP was all right. All the bears on Australia think the iron ore price is going to turn us into some great housing crash driven by iron ore. I don't share that view, and I think the East Coast of Australia is going a lot better. Tourism, retail sales, house construction, infrastructure construction. I think Australia's going a bit better than the consensus view, is my view, and maybe that'll come through next year.
Commodities, energy stocks, miners.
Too hard.
Too hard.
No
bottom yet?
No, I don't think. I think it's impossible to say that. Yeah, we've had a look before. We tried to bottom fish in a couple of things and lost a little bit of money actually, and so. Yeah, in my view, resource stocks never bottom until the commodity prices actually bottom. And you can't put your hand on your heart and say iron ore's bottomed, or liquefied natural gas has bottomed, or oil has bottomed, or copper has bottomed. Gold might have. There's a chance. Gold stocks did quite well today in America and in Australia. And there's a chance gold might bottom first, is my view. But even that would be a guess. So I don't like guessing. I'd rather buy these stocks 10 or 15% off their lows, knowing that the commodities have bottomed. But at this time, you can't say that. So our portfolio globally and locally is very, very industrially biased and biased to growth.
Okay, let's talk some stocks. First, I want to talk about IPO today for a Switzer regular, John McGraw. Listed his company that he's owned and founded and run for many years. Yep. Tough day on the market, or tough debut. Talk us through what happened and talk us through your view on that stock.
Very surprising. We supported John's float in a small way, and we thought that John presented the company very well and the growth aspects of the company going forward. It's got no debt. Between when we subscribed for the shares.
Disorganised, the company was disorganised?
No, just the market was a bit disorganised. It seemed strange, the trading in it, and eventually it closed down 11% or so. I think there was a few people who, were probably surprised they didn't get a flip out of it and just sold the shares, and that became a little bit of an escalation. But I would not change my view on John just because the share price is down 10 or 11% on the first day. I don't think that changes the outlook for the company.
Medium to long-term
I think he has the ability to consolidate the sector. He's a winner. He's involved in REA. He's built a great brand. The guy's a winner. He's Australia's probably best property guy, and he will build a good business. So other stocks through time have debuted poorly on day one and gone on to be good stocks. So I will be patient with that one. We've probably got to work through some disappointed liquidity over the next few days or weeks. But John's a winner. His company's got no debt. He will consolidate the industry, and I think at $1.83, it's a very interesting stock. Well, to me, there's not much difference between the company today when we bought them at $2.10 and what they are at $1.83 today. So surprising, but we can work our way through it.
What else do you like right now? We've been writing some interesting notes for the Switzer Super Report where you mentioned a number of stocks, Baby Bunting, Link. Talk us through those two.
We have a big tilt to growth. I'm just trying to find things that can grow, that have a bit of structural growth themselves and have some tailwinds. Baby Bunting, only a small cap stock that recently listed, I think can grow probably 20% compound over the next 3 years. It's on a PE premium to the market, but all things that grow, that have structural growth are more expensive than the broader market. Go back one step, Marty. We're trying to look a bit outside the top 20 for growth. And, lot of the IPOs have had growth. That's why McGraws a little bit of a surprise today. There is a growth profile there. The market just sold the shares off 11% for no apparent reason. So I'll stick with McGrath because I think there is growth there.
Yeah.
We've also taken Link, which is a registry services business and financial services business that services the superannuation sector. Again, should have 3 years of 20% earnings growth. Yes, you've got to pay 20 times earnings for it, but if it delivers those earnings or more, they should outperform.
What's the code for that stock, Charlie?
Link is LNK and Baby
LNK.
Bunting is BBN. Both been good performers since their floats. We've also got a big position in Macquarie Group. Our biggest position is Macquarie Group, which is a top 20 stock. We think their growth profile is strong. We think they're in an earnings upgrade cycle. And we think their earnings will beat expectations. So we've got a very big industrial bias, very big bias to growth. We've also got a lot of exposure to the NASDAQ market, feeling technologies.
So back to Macquarie, is that your bet on the fact that you believe markets have got further and harder to run?
Yeah, no, it's more of a bet on Macquarie themselves.
Okay.
Yes, it's got market leverage, and yes, if markets go up, Macquarie will go up as one of the world's biggest fund managers. But I think they've got earnings growth that's beyond the market's current consensus. I think that the dividends will be beyond the market's current consensus, and I believe in a year or so's time, it's probably a $100 stock. That's not a big call, they're $83. I think they're the premier growth stock in the top 20, and it's our biggest bet. So it's more of a bet on Macquarie than markets. Okay. If I want to buy markets, I can buy index futures. I want to buy good companies that can grow, and then my play on that in that place is Macquarie.
Okay. 2015, we said before, was a tough year. What are you looking? How are you viewing 2016?
Well, interestingly, interest rates in the world are going to stay very low. The ECB just cut them again. Japan's looking like cutting them. Australia's probably going to keep them down here. Fed will put interest rates up in a small way this month. But it's about the wording, Marty. If it's a dovish hike, which means their wording is very gentle about how slowly they're going to do it, markets will rally, led by Wall Street. I think Wall Street will close an all-time high by the end of the year. I think the American market will start moving quite sharply from that Fed lift-off, and you actually see relief rally in markets where people go, you know what? 0.25 cash rate, is that really going to stop us? The confidence that the Fed has got in raising interest rates is the most important thing in the whole market. Because when they didn't raise interest rates in September, we had a deep correction because the markets felt, what does the Fed know that we don't? Well, the answer was nothing. It was just a correction driven by the Fed. So the Fed is very important, the confidence they bring to markets. I think we'll get past liftoff.
Are you confident that Yellen will get it right this time? Because you were quite critical of her in some of your notes.
I think her wording previously was terrible, and I think she created confusion and she spoke too much and too many Fed governors speak. 91% of economists think they're going to raise rates on the 17th, including me. They will do it, but it's in the wording. If they get the wording right about the trajectory and the path of future rate rises, markets will rally, led by Wall Street, and we'll have a good end of the year, hopefully.
So what if unemployment in the US, with our good payroll numbers, continues to fall? Will that change the speed at which they'll increase interest rates?
No, I think they'll do it very gently because they do not want a rampant US dollar. What they actually want is to put up interest rates, control the US dollar, which has already moved up 25%, and just do everything very gently. The last thing they want is a 20% higher US dollar from here. And the most controversial thing, I believe, is at Fed liftoff, I think the Australian dollar is going to rally. I think the world is very short Australian dollars. The Australian economy is doing better. If the Fed is a bit soft on its wording, the Australian dollar could end the year at 76 cents, which would surprise people, but be good for the share market because foreign investors would chase the currency.
So from a global asset allocation perspective, which market do you see the most growth at a reasonable price right now?
It's generally America.
Okay.
American technology. Big incumbent American technology stocks are cheap. Be it Apple, Microsoft, Alphabet, which is the old Google, Amazon, they're cheap. If you look at price to growth ratios and their balance sheets, remember most of these guys have got 100 billion of cash on their balance sheets. Those stocks are cheap and they continue to grow. Every quarter their earnings have been better than expected, except for Apple, which had one quarterly miss. But things like Microsoft, Amazon, Google, I think are great companies. And that's where price to growth is cheap, in my view. In Australia, I do think Macquarie Bank, things like Link, Baby Bunting, there's numerous examples in Australia.
Europe?
Europe a bit different, too reliant on the ECB in my view. The currency keeps rallying a little bit there. I think Europe stalls a little bit. So we prefer America and Australia and parts of Asia at the moment.
UK? That hasn't good numbers of late?
No, we think it's very bespoke in how you have to, what you can buy from an equity world there. It's a very global market, the UK, and we're not 100% sure on the pound. The market has marked the pound back a little bit lately, feeling that interest rate rise expectations were a bit premature. I don't know. I think the place you want to have your biggest bets is probably America and probably tilted to technology.
Charlie, thanks for your time.
Thanks, Marty.